Hello everyone, welcome to today's US Open live webinar. It is Tuesday, December the 6th. This is your host Nikos Zabouras, Senior Market Specialist at FXCM. It's been an eventful few days since our last session in the previous week. We have the COVID-19 situation in China being front and center, and markets also continue to assess various data points, and we've seen that they've been quite edgy and reacting to the data as they're coming in. But before we go ahead and start with today's session, please read carefully through the disclaimer and risk warnings, and then we will get started. Once again, please read carefully through the disclaimers and the risk warning, and then we will go ahead and start with today's and developments and the ones of the recent days. Okay, so let's get the ball rolling as we look at the Euro-USD chart. Before we get into the technical outlook, let's go ahead and see some of the recent developments. As we said, it's been an eventful period. The market seems to be edgy and reacting to various data points as they come in, often in different directions. Now, as we said, China is one focal point because we have seen over the recent days some easing of the strict COVID-19 policies, mostly on a regional level, mainly. For example, actually, Beijing has ditched testing requirements for access to supermarkets, public transportation, etc., and other regions similar in Shanghai, Shenzhen, and elsewhere. So there's definitely a shift there. It's not a U-turn and from the zero COVID policy, but we are seeing some easing. Of course, cases remain elevated, and there is some uncertainty as to what the impact is going to be on that. Now, over the weekend, we also had the Organization of the Petroleum Exporting Countries and allies such as Russia, a group commonly known as OPEC Plus, maintained their output cut program. Perhaps China optimism helped there, because if China reopens, then demand, which has taken a hit and is expected to continue to suffer next year, in the opening of China would help towards this side. Now, yesterday, the US dollar rallied because of an upside surprise in services activity and factory orders from the United States. This sort of firmed up again expectations around the Fed's path, not so much for the next move in the upcoming week, but as to the terminal rate and how long the bank will need to stay in restrictive territory. Today, however, there was another bank that was in the spotlight. It was the Reserve Bank of Australia, which hiked rates to the highest levels in 10 years and pointed to more tightening ahead, and this helped the Aussie. But we'll cover all of those later. Today, we're seeing this dollar strength that we saw yesterday. We're seeing it moderate. Is the green backs off, and we're in sort of mixed situation. Let's get ahead with the technical outlook of Euro-USD. After a volatile session on Friday due to the NFPs, the week started on the back foot because of strong data from the US that we said. This is the highlighted part you can see is the actual drop of Euro-USD due to the aforementioned data. However, today it finds support. So where does this leave us on the chart? And we're looking at the hourly chart. The pair is now vulnerable to the 200 days EMA, the exponential moving average, at around 1.0390, and the catalyst, however, would likely be required for a breach, and the 1.02 handle looks far away for now. Now, despite the poor start of the week, as we said, the bear finds support today, and there is some optimism turning due to the China easing of the lockdowns that we have already talked about. And this keeps bulls in control, and they can take another crack at 1.0609, although we're still not confident for a sustained advance beyond this level. I guess it's all gonna come down to the policy decision by the Fed and the European Central Bank next week, and this could also create some indecision in Euro USD ahead of these events next week. Just to remind our listeners that the Fed is looking to moderate its pace of hikes. Chair Powell rubber-stamped this last week. He talked of a slower pace of hikes, and markets expect a 50 BPS move after a series of 75 BPS increases. And inflation data have been supportive, but on the other hand, strong data do point to more tightening ahead. While on the ECB front, they're also looking to downshift, and we have seen various European officials talking about a smaller hike in December as well. At least they seem to be more focal at this stage, whereas there is some division, we would say, there as well. It's not clear, and some of them have definitely not ruled out another outsized move. Now, let's shift away from the Fed and the ECB and look to AUD USD for AUD USD for the reaction to the RBA decision today. So what the RBA did is hike rates again. The Reserve Bank of Australia has already been slowing its pace of tightening, because today's was the third straight move of a smaller 25 basis points, which still brings rates at the highest level since 10 years now. However, officials do expect more tightening, and this helps the Aussie and, of course, the China story also. Now, on the technical front, last week's advance failed above the 38.2% FIBO. Let us highlight this here, of the 2022 high-low drop. And the poor start to the week exposes the pair to the 200 period CMA at around 0.663. A breach could pose upside momentum, but the downside seems well protected. We have the daily Ichimoku, the 0.65 round figure, and the ascending trend line from this year's lows. So overall, it seems well protected on the downside. And as long as the pair stays above the 200 period EMA, the black line here, bulls are in the driver's seat and can take another crack at the 200 days EMA here. But we can say we are convinced at this stage for sustained strength past 0.6917. That's it for the Aussie, and we also have the GDP data coming up tomorrow. We'll talk about that towards the end of the session. Now, let's now go to US oil. As the US markets are about to open now, let's talk to the US oil and we'll circle back to the US markets towards the end. Now, as we already said, OPEC Plus did not deepen its output cuts, maintained the October's massive 2 million barrels per day reduction. This is still massive, but probably the situation in China helped to hold its fire. Now, cases are still high, and also against, let's say, the commodity works the price cap that the European Union finally agreed on Russian imports at $60. That's high, but still it is something, along with the ban on seaborne oil imports to the European Union. So essentially what we see is that this push and pull between supply and demand continues. Now, given all these factors and the dollar strength that we saw yesterday, the commodity is in a tough spot right now. Last week's advance was contained by the 200 periods EMA that we see here, the black line, and that makes vulnerable to the EMA of 200 weeks, the blue line here, and of course new 2022 lows. However, we can see that the RSI points to over sold conditions, and that we have maintained for quite some time now. It's hard to see sustained weakness below the 200 weeks EMA at the $89-90 region. Sorry, not the $89 region, but actually here the, let's say, 72 region. Now, as we said, there's a push and pull around between demand and supply, and OPEC has definitely shown willingness to support prices. So we can see, given the RSI also that tries to move away from oversold territory, we can see strength towards the 200 period DMA, but we will need daily close above this level for momentum to shift to the upside and bring the 89-90 region here in the spotlight. I also want to, before we go to the US indices, I want to also take a look at the German index. And looking at the 4-hourly chart, it doesn't really tell us much. It comes from an impressive 2-month rally, but has been lacking, let's say, vigor recently, and ended last week flat. This creates scope for a correction towards the broader 14K region around here, but it's hard to see a steeper decline. ECB commentary this week is supportive, and China optimism too. It's still early, but the daily chart is quite interesting. You can see here a golden cross. It's still early, it has just formed, so we will need to wait a few days for that, which is a smaller EMA crossing above a bigger EMA, a faster above a slower. In this case, we're on the daily chart, so this tends to be a precursor to further strength. And the last time that such a formation took place was in July 2020, which of course led then to the record highs that we saw in 2021 and 2022. Back to the 4-hour chart, a pullback may be needed for bulls to find renewed strength and attack the 14,960, 14,000 mark, but this may prove elusive in the near term. And let's move to the broader SP 500 index. It's cautious. It dropped yesterday in line with what we have discussed, and the previous week's advance had been contained by the descending trend line from the record highs, and we can see that now there's the 4K handle. From here we can see further pressure towards the 200 period DMA at around 3,930, but under current conditions it's tough for daily close below it, while the daily Ichimoku cloud further down can also provide support. At this stage, still momentum is on the upside, and we can see another effort for higher highs, but the 4,200 region will require a strong catalyst and may be hard to see in the near term. That's it from the technical outlook. Now looking ahead, there are a few things we expect. We have the Bank of Canada rate decision on Wednesday. The BOC has moderated its pace of hikes, coming down from a massive full percentage move in September, whereas the last increase was of 0.5%. So we will be looking at how the bank proceeds. It does expect further moves. Now, earlier on Wednesday, as we said, we expect Australia's Q3 GDP. Q2 was plus 0.3.6 year over year, and the Australian economy has shown significant resilience despite the monetary tightening. And we also be expecting the GDP figures from the third quarter from the Eurozone. The preliminary reading was 0.2% quarter over quarter, whereas the Q2 final was 0.8%. Now, it depends on how we look at it. 0.2% is obviously anemic growth, but it's still growth, and the European Union has avoided, the Eurozone, sorry, has avoided a recession. So that's it from us for today. We'll talk again today's on Thursday at 14:20 GMT, 10 minutes before the US Open. Thank you for joining me.